is Adam Rose, Vice President and Senior Loan Officer at Western Ohio Mortgage, located here in Sydney, Ohio. And this is another episode of the Mortgage Guy podcast. And today we're going to learn a little bit about what's going on in the market, so a market update. And I do have a guest, and before I even get into that, I'm sorry I sound a little under the weather here. So I do have a guest. His name is Justin Hughes, and he works here at my office here in Sydney. And since this show is not really rehearsed or anything like that, right? We kind of just go off the cuff, Trump style. So who knows what we're going to say. First thing is, tell our viewers a little bit about what you do for us here.
Yeah, so I'm a licensed marketing assistant. I do a lot of pre-approvals, a lot of documentation collection from either borrowers or agents.
Okay, so yeah, like I've mentioned before, he's
and a lot of odd jobs.
He's kind of our utility player for job security when it comes to talking to the consumer, talking to agents sometimes, the title companies, insurance companies. He's helping me out with online applications, and a lot of our agents and our partners kind of know who Justin is. They've spoken to you before, as well as our borrowers. Yeah. But he does some IT work for us. He runs errands. He does everything. Right?
Do a lot of
all jobs. So yeah, he's got pretty much everything covered. So what we're going to go into today, guys, it's going to be a little bit different. Instead of just watching us this whole time, this whole video, you're going to be looking at some paperwork, okay? And we're going to be discussing the mortgage insurance changes that have come down the pike from FHA, and we're going to talk about some changes that are going on with Fannie Mae and Freddie Mac and their LLPAs. So let's take a look at your screen.
So what you're going to be seeing now is just a quick snapshot of what like a $150,000 purchase price is. The rate's moot. None of that matters. What we're looking at is kind of that bottom line, right? So this is what that standard FHA payment was going to look like on this price point with the current mortgage insurance premiums. Now, the current mortgage insurance premiums, anytime you're doing less than 5% down, they're 0.85%. You put a little bit more down, they're 0.8%. So the new announcement that just came out is they're going to drop to 0.55% for less than 5% down, and 0.5, right? 0.5. There's some other weird stuff in there when it comes to refinances and funding fees and all that,
right?
But that's not going to have as much of an impact on the market as what this is going to do for purchasers. So the next thing you're going to see on your screen is the next payment estimate. So again, same sample, right? 3.5% down, $150,000 sales price. That payment difference is, am I crazy? Is $36.
Yeah.
Is that right?
Yep.
I
mean, you look at mortgage insurance there.
I'm pretty good at calculus. I'm just basic math. That's what my wife would say. It's like, I don't know.
Rough math.
So yeah, so about $36 difference. Now that doesn't seem like a lot to a lot of people, but that's huge. So the 0.3%, guys, when you're looking at this, you can equivalency is like a rate reduction. Right? That's really what it is, right? Because you have 0.85, it goes to 0.55. It's just like having a 0.3% rate reduction naturally just from doing this program now.
Absolutely.
Right? And that has nothing to do with credit scores, right? There's nothing to do with that. It's not like, oh, you got to have a 740 to get that rate. No, that is 580 to 800. Doesn't matter.
FHA.
Right? Anybody that can qualify for FHA, they're going to get the benefit of this. Now, why this is so important, so even though in this example it's a $36 drop, and what I was kind of playing around with in my head is, okay, if I get selling $36 a month in savings to a buyer, that's probably great. Selling to a real estate agent might be a little bit more challenging, right, because of the market that we're in.
Right.
But that $36, when I was playing around with numbers, that's a little more than $5,000 in purchasing power. And what I mean by that is, let's say your client went in at $150 and has enough money for the down payment, but the seller has multiple offers. They're not going to pay any closing costs. Right. Well, this could give you an opportunity to even possibly go a little bit higher on your offer, right? $5,000 more, still qualify because of the reduction in the mortgage insurance premium, and maybe even have your seller cover some of your closing cost expense. It can be used to buy more house. It can be, there's
a lot of options for that.
Right? So it's a good thing. It's a great thing. So, we're trying to do our best to educate some of our real estate partners out there in hopes that they will accept FHA, right?
It's a good product. It's got a bad stigma for whatever reason,
Right,
but
it does.
it's still a great product, and more often than not, it's more affordable for the borrowers.
Yeah.
More buying power, cheaper payments, whatever the case may be, depending on your situation. But
Right. Yeah, I think it gets a bad stigma because everybody thinks, hey, if this guy's going FHA, he must have a terrible credit or bad job time or
Right.
whatever it is, and that's really not the case.
Not
all
at
the
all.
time, right? I mean, we see a lot of files where we just swing this puppy FHA, maybe because of debt ratio issues,
Right.
right? Because some products are a lot more stringent, like the USDA files, even conventional
They're
is
pretty tight.
is much more tight than what FHA will allow. And as everybody's seen in the market, with the higher price points going on, and we have high rates mixed with it right now. I mean, people are maxed out on what they can afford.
Absolutely.
And having the ability to look at this FHA product and having a small reduction compared to other programs is, I think, extremely important. So I hope everybody that's listening out there that has done an FHA loan in the past, I really hope you guys entertain it if you have a buyer that comes up to you and offers that route. Because it really is. It's getting more competitive. It's a great program, and so please don't dismiss anybody that's looking through that program. We want to talk about one other update, and that's Fannie Mae and Freddie Mac, right? So this is conventional financing, right? The Cadillac of the financing world for residential, right? What everybody thinks of, what everybody wants to put 20% down. I don't want PMI. It's I can finance this house that's run down that no one can live in. That's false, by the way. Yep. You can come see me afterwards with any questions on that. But that's the loan type that everybody's pushing because it's a little less stringent on underwriting criteria, and usually people have stronger credit.
Mm-hmm.
But we have some changes coming down the pipe here. So within the next month or so, I really think when I was looking at pricing on our rates and things that have been moving in the market, I feel like it's starting to raise its head, right? I'm starting to see it in pricing. I feel like investors, secondary market, they're ready.
They're going
like,
to get ahead of it.
We're going to start adjusting this now, so this is not some massive shock in a month and a half or whatever, right? So because I think it's based off of when it closes, not like, hey, on May 1, it all changes on applications. I think it's based off when it closes, right? I mean, we can double check on that. This is just, and I'm sure if we have any lender friends that are watching this, they're probably going to call me out. So that's fine. Whatever. Anyways, so what we're going to pull up on your screen next is this is just the purchase money. All right. So this is just for purchase transactions. This is not going to be your refinances, which is different. They're putting in new LLPAs. So what the hell is an LLPA? It's a loan level pricing adjustment. Okay. So in the lending world, when we're pricing out interest rates, I mean, people are pretty already aware that if I have a 620 credit score, my rate might be different than someone that has a 680 or 700, right? You can think of that as a loan level pricing adjustment, right? There's some changes there. Now, what we're showing you is not rate specifically changing, okay? There's a price associated when we deliver these loans to the secondary market, but it can have an impact on the rate, okay? So I want you to take a look at your screen, and now the first thing that we're going to do, we're going to highlight this for you, is the very, very top box. To the left, you will see greater than 780 credit score. So we're talking near perfect in every credit category that's out there. If you move over to the right, 70% to 75% loan to value. That is now the baseline, it seems like, but for that 780 and higher. You'll see 0%. That means there are no adjustments. You basically have to put 25% down or more. There is no adjustment. Now, as you look to the right, okay, we're going to highlight this across the screen. Once you go to about 20% down, they're going to hit your pricing, 0.375%. Now, again, I can't give you a dollar for dollar, a rate for rate, what this means exactly.
Right.
Basically, you're getting dinged.
Right.
I mean,
penalized for lack of better terms.
You're being penalized. It could be 1/8% of the rate. It could be a quarter. It could be nothing. Maybe there's a discount, right? But there's going to be a change.
Right.
For you being responsible and saving a lot of money to throw down, you will be impacted. So as you can see, as we go to the right, a little bit higher LTV is the same as the 20% down. Now this is where it gets interesting because the whole purpose of this is to make home ownership more affordable, right?
Mm-hmm.
Is to help close some of the income gap, some of the affordability gap, which I support that 100%.
Absolutely.
They just didn't do it right? I mean, we're penalizing people
You're
just
getting penalized
because
with putting more money down.
Yeah, right. Why wouldn't we just incentivize, give different programs to help out with this, that have less down and stuff like that. So that's the whole point of this conversation. But as you can see, as you go to the right, you're putting less money down. It's more attractive now, right?
Yep.
So lenders have more risk involved, but it's going to make it more attractive for buyers. Okay, so we do a ton of the 5% downs and the 3% downs.
Oh,
do a ton. We love them.
Absolutely.
Right? There's a bunch of great programs out there. Fannie Mae Fannie Mae Home Ready, Freddie Mac. What the hell is a Freddie Mac? Home Possible. I couldn't even think of it. So, they're great programs, but we're really just beating the crap out of people that are saving a ton of money. So the next thing on the screen that you're going to be looking at, we're going to highlight this for you guys. So when you go down to the 660 to 640 range on the credit scores, take a look at the hits there, okay? Basically,
Huge.
If you are under a 700 or even a 720, we're probably going to try to avoid this. Well, not necessarily avoid. I don't mean to say it that way.
No.
But FHA is going to be your answer.
Right. It's going to definitely be cheaper.
Right? I mean, and at some point, I know we still have a tight market. We have very few homes out there and very competitive offers. I get it. But we need to start looking at doing what's best for the client, right?
Absolutely.
Not just the seller. The seller's going to get a great offer. But, have that conversation when you have a buyer that comes in with an FHA offer. Talk to the lender a little bit. Granted, there's only so much we can tell you, but just because it's an FHA offer doesn't mean it's a bad offer.
Right.
And we are going to have a lot of traditional conventional buyers start moving over to this different product because it's just going to be more attractive to them,
mm-hmm.
right? I mean, so that's what's going on. And down a little bit farther on your screen, guys, we're going to again highlight this for you. At the very, very bottom, I'll do that first. We now have a new adjustment, and this is where it's going to be causing some problems, okay? So they are adjusting and hitting the price once again, depending on the debt ratio. All right, so here's why this is problematic. So let's say me and Justin sit down, and we're doing a loan, we're calculating the income, and we got it all figured out,
mm-hmm.
right? Well, how often does our income stick when it goes to underwriting?
Not very often.
Not very often, right? It doesn't.
Something changes.
I mean, we're right. I feel everything
I'm
I'm looking is right, but verification of employment comes in, something's a little off.
Overtime,
OT drops off. They miss a couple weeks of work year to date on a pay stub that's not there. So income gets adjusted. Okay. So let's say I quote a borrower. We're just using round numbers. It's a 6% rate based off of their credit score and their LTV under a 40%. So let's say it goes through, and I've locked this interest rate. Okay, I've locked it on the secondary market, ready to go. Okay, underwriter gets a file. File's approved. That's fine, but they have an undisclosed debt. They have, I don't know, a little short on the income, and it could be minor, right? I mean, you could have missed it by $50 a month.
Year to date was off just
year to
slightly.
date, whatever it is, right? Insurance, homeowners insurance comes in, and it comes in an astronomical amount,
right? Because you bought in the country, or
what else? Flood insurance come flying in
that
we didn't know was flood zone. I mean, there's so many things that can impact the debt ratio, right? That's why when we do these pre-approvals, we try to give us a little bit of cushion, or we quote it maybe a little bit higher on the rate just to be safe.
Yep.
Well, if that debt ratio kicks up a little bit, so example, look at the 20% downs, the 15% downs. There's a 0.375% adjustment if your debt ratio goes over 40%. So the old school way of, hey, how do we fix this debt ratio problem? Well, we throw more money at it, right? I mean, that's a solution, possible. Or you make more money, one of the two.
Right.
But here's the problem, right? So let's say we throw more money down at it, and you go up to and you kick yourself into a new loan-to-value range. You did not help yourself.
No improvement at all.
There's no way to fix it. So now we have a rate locked in, of which I'm going to have a hell of a time honoring, or I have to get approval from secondary to say it's we'll honor this even though we just took a bath on 0.375%. So those are the problems that we're going to be running into with some of these changes, and we just want to make you all aware of it. So this is it's going to be a difficult situation, and I know that the Mortgage Bankers Association is doing a lot of lobbying, and there's a lot of pushback with this specifically against Fannie and Freddie. So.
Do you think they would change it? Do
No.
you think there's modifications?
I mean,
Anything?
complaining works sometimes, but it's usually like at home, right? Like
Right.
your wife's getting on you about something, and it works.
Not
but
the Congress or
they don't-
not in D.C.
the size of Fannie and Freddie, they're to the point where they probably really don't care.
Right.
You know, it doesn't. I just want to drink my coffee first. This is your commercial break for the Mortgage Guy podcast. No, just a little branding opportunity there. All right, so real fast, the last thing. How much time we got? Holy crap, we're moving. Okay, so we may have to cut that out. Sorry. So I'm not going to ask Justin a crazy real estate story. We may have him tell one sometime if he has one off the top of his head. But
I'll think of one.
so the last thing, and then I forgot to say it before we get to the last piece, is he's our utility guy, right? He does everything around the office. He also does all my video editing. I forgot to mention that. So
It's not a good thing.
And for those of you that don't know, he's moving out to San Diego in 2 weeks. He's still working here. All right, so
I'll still be on the phone.
He's going to remote in
email.
and do all that fun stuff. And we'll probably have, and this wasn't announced yet, but we'll probably have extended office hours because of this.
Yep.
Since he's going to be on the West Coast, we'll probably have him working until 7:30 Eastern time, which will be nice. So we'll keep you posted on that. But this last page that we have up on your screen, this is kind of confusing. So we'll probably clean this up. But it's just giving an example, conventional to FHA, basically with the new mortgage insurance premium, same rate, same everything with 10% down. The payment on FHA ended up being slightly cheaper. Okay. Now, on the LLPA topic, right below it, which again we'll probably clean up for you so it's a little bit easier to understand, you will see, where was the example at? Was that a 700 to 719 score? Is that what that was? Or was it the 720 to 740, Justin? Do you remember? 10% down, right?
I thought it was the 720 to 740
I did too.
with 5%.
Okay.
Or, well, 90 to 95%.
Yep, there it is. Okay, gotcha.
Yep.
All right, so this is the changes that we'll see in the LLPA, right? So we have this down payment. The based off the down payment with a 720 to a 739 credit score, 0.875% hit, debt ratio over 40, which is an additional 0.125%. The equivalent adjustment in the rate was a quarter. Okay, so now with the new LLPAs, the principal and interest used to be $14.22. It is now $14.59, a $37 change to apparently make homeownership more affordable.
Makes sense.
Right? That's
All right.
the purpose of this.
Let's make it more expensive.
Yeah, so that's what we're dealing with right now, guys. And again, the reason we're doing this market update is to make you aware of these changes. They're again, FHA mortgage insurance premiums. We're disclosing that now, right? Because it's based off endorsement date. It starts like next week sometime, so that is safe. You can start using that right away. That lower payment. LLPAs, I'll have to confirm, but I want to say May 1. Hell, I don't remember. There's so many damn changes. So I think it's May 1, but I really do think we're starting to see some adjustments now, slowly and surely going into there. But we want to make you all aware, right? So this is what's happening in the market right now. You want to coach your buyers, and on the listing side, please don't dismiss that FHA offer. It does not mean it's a bad client. It's not a bad deal. So we just got to keep an open mind on what's going on because there's just so many changes happening. And we're doing, as a lender, what's in our best interest of our client in regards to affordability and the loan program that they fit into best.
Right.
That's what we focus on first. Because we always get that question, well, hey, is there any chance you can go conventional? We get that a lot.
We do.
Right?
Very often.
I mean, geez, a lot. So, and it's not to say that they can't, but it will come to a cost to the client.
Most of the time, it's not the
Most
cheapest
likely.
option for them.
Yeah.
And
So, like I have a feeling where you're going to, but over the long run, conventional is typically always a better choice because the mortgage insurance coming off, right?
Right.
At 20% down or 20% equity.
Right. But in this market where refinancing is probably going to creep up at some point,
Bingo. Yes.
it may not make sense today.
Yes. This is not wood. I'm going to act like it is. But knock on wood, the market's supposed to start shifting someday. And we're going to see all these people that closed in April, May of 2022 all the way up through now. Hopefully we'll be in a refinance position and save them more than a point on the rate.
Absolutely.
I mean the absolute expectation And again, I'm not quoting rates and terms here, so I don't need a damn disclosure for this. Is we're shooting the hope is to hit that 4.75, 5.25 range, kind of like a normal market again one day. So
That would be ideal.
that would be sweet. So I think a lot of people would be really happy about that.
All right, guys, I hope that was some really good information for you to take away. Whether you're a consumer and learning about that, obviously give us a call with any questions that you have. If you're a realtor partner, if you're in the business, obviously give us a call as well, how this can impact your client and how it's going to impact the market. But I hope it was good information, right? We had some pretty good conversation about it. And that's it for us this week. So, guys, just remember, click it, like it, subscribe to it. Remember, on YouTube, it's free. So click that subscription button. It ain't going to cost you any money. And we'll see you guys next week.